Pawan's back with us. Pawan, just wanted to understand where within the entire consumption basket you think the selling may be now done with, and one can at least start nibbling in.
See, I think one thing which is very clear is that, the selling that's happening, is across the board. It's fairly secular, and it's not, and the selling is clearly driven by the need to exit India and not driven by the fundamentals of each and individual stocks. Having said that, I must tell you, consumer discretionary as a basket, if you see, a lot of the categories have done reasonably well. So jewelry has done reasonably well, apparels have done reasonably well. Some of the retail companies and the apparel side have delivered decent set of numbers. I would want to believe that, with this decent festive season, which has largely been in Q3, these themes will further accelerate, and valuations after the correction have become very, very, very palatable. So those are the segments, which I think should do well, and segments where there is a reasonably good amount of earning certainty.
Okay, let's see whether that happens or not. But for now, it's a sharp cut that we have at our hands. 200-day moving average broken. On an intraday basis, we just managed to defend the 500 mark, 23,500. That's the level Naresh was watching out for. So at least for now, we went to 23,509, and from there made a bit of a bounce back. But it's a very, very feeble attempt of a recovery, at least at the moment. 15 minutes left for the trading session, so let's see which way it closes, but definitely a 350-point slide is what we are witnessing on the stocks right now. The biggest losers are HDFC Bank, ICICI Bank, M&M, Reliance and SBI. In fact, SBI is down 2.25%, but it's HDFC Bank and ICICI Bank which are seeing the largest amount of pressure. Surprisingly, it's Tata Motors, Britannia, HUL and NTPC which are holding up in the green at the moment. So a bit of an outperformance, if you must, from some of these names. What do you think, Naresh, has FMCG bottomed out a bit? HUL, Britannia holding up in this market?
So I would say bottoming out, not necessary, but a bounce could be in play given the extent of the correction. So if you look at HUL, the stock was at 3,000 plus. Now we are at 2,400, 2,500. So it's seen a good 15-20% correction across. Same is the case, Dabur from 670 down to 500 odd levels. And now 480 to 500, the stock was back in 2022 as well as back in 2020. So overall, the correction has been large. The last 3-5 year returns come down to zero. So there could be a dead cat bounce across the whole FMCG pack purely for the fact they've corrected 15 to 25% from the top.
Point taken. What's holding okay in this market is actually Swiggy. It was expected to make a very lukewarm listing of sorts. The subscription wasn't, blow away number of sorts. It was decent at around 2-3 times, but the retail portion was a little less subscribed. In fact, Swiggy has piled on gains. I think it opened with a gap up of almost 6-7% or 8% thereabouts. It reached a level of 14%, and right now it's 16% higher. We all saw that camaraderie between Zomato as well as Swiggy with the update coming in on Twitter. Even Dipinder Goyal put out a tweet welcoming them to the bosses, and seems like the street, despite the market mood, has welcomed them with a bit of a green. Pawan, any view on this space? Because on one hand, of course, this was a disruptor and kind of filling the gap that the consumers needed, but on the other hand, it looks like there is some lobbying against the quick commerce bit a bit, and the government and certain at least bodies are coming with a bit of a heavy hand on some of these.
No, I think, these things, I think both these companies have seen quite a lot of this in last 10 years or so. I think earlier also there was a chatter that some institutions or organizations will develop a competing app against Zomato and Swiggy, but none of that has happened. I think it's a very tough business to execute on the ground, and given the work that they've done on the quick commerce side, that had actually further strengthened their fold. I would want to believe that there is no scope for more players on the food delivery side, and then the consumption or growth in terms of GMV and in terms of user addition that is there on this platform will only further increase from here on. The only thing that I'm really worried about is that what is the fair value for these companies, once this growth tapers off in next 3 or 4 years. Maybe in next 3-4 years, the growth will not be 25-30%, maybe about 15-20%. At that point in time, what is the valuations the market would want to give at that point in time is a question in my mind. But until then, in next 3-4 years, we like these businesses and we are kind of invested in these names as well.
That's that, and quite surprising as it may be, Swiggy is one of the resounding winners today in an otherwise such a weak market, 17% higher on its debut day. on its way to clock now an 18% premium to its issue price. 459 is where Swiggy is, and decent set of volumes as well clocked in on its day one. But other than that, we were just mapping how much the sectors have actually cooled off or fallen from their 52-week peaks, and it's actually the media sector, a good 25% fall. Oil and gas has come down quite heavily with almost a 20.5% cut. Even realty, the sort of poster boy of the recovery since COVID, this has been one of the very resilient sectors that's also fallen a good 19% from its 52-week highs. But again, this is the fall from the 52-week high. On a net basis through this year, most of these sectors would still be sitting at gains. But yeah, it's losses galore throughout. I can't point any sector which hasn't fallen from its 52-week peak. It's largely healthcare, the services sector, banks to some degree, and IT definitely, which are a lot more resilient and have fallen a lot lesser than what some of the other sectors have done. But Naresh, do you think that Nifty IT, even though it's fallen only 3% from its 52-week peak, if the market were to correct further, it's not going to fall further with the market and will continue its show of resilience?
So I would expect it to continue to show resilience, given that there is a lot of correlation with US indices over there. So out there, we've clearly seen good recovery. And mind you, from 2021, the returns are not great. So the bounce may look large from the recent lows of the last 1 year, but they've not done really well in the last 3 years. So overall, in that scenario, would expect it to be resilient, may not rally and make into new all-time highs, all of them. But some of the IT companies do look very interesting on a technical basis. Something like a Wipro, HCL Tech still look very strong.
Point taken. That's the view coming in on some of the IT companies. But we have been speaking with a whole host of other market men as well to try and understand what the mood is like. No better time than right now to take stock of that. There is a bit of a recovery. We are attempting that 23,600 mark. But here are the latest commentary coming in from some of the market veterans.
While earnings are soft and have seen a very distinct moderation across the board, the picture looks slightly better if you account for the big drag from a few of the commodity-oriented sectors. For Nifty also, the earnings are flat. But more importantly, the internals of the earnings are very weak. As you mentioned, we've got earnings of about 100 companies by more than 3% for FY25, and we have upgraded for only about 36, 37 companies. So that is close to 3:1 in favor of downgrades. Secondly, we've cut the earnings for Nifty also, the EPS, by close to another percent in the interim review that we did. This comes on top of the 3% or 3.5% earnings cut that we did at the time of preview. So net, if you see from April to November now, our EPS estimate for Nifty are down close to 8%, from 1,140 rupees to now about 1,060 rupees. Which basically means that FY25 is going to be just a 5% earnings growth year, right? We are not used to single-digit earnings growth for the last 5 years now. Between FY20 to 24, every single year was a double-digit earnings growth year, and we've had a 21% earnings compounding between FY20 to 24. So clearly, FY25 is occurring as a bit of an outlier in a 5-year, 6-year trend, where things are slowing down a bit. There's moderation, there's a breather. And of course, it's also a reflection of the government spending being down. FY25 is occurring as a bit of an outlier in a 5-year, 6-year trend, where things are slowing down a bit. There's moderation, there's a breather. And of course, it's also a reflection of the government spending being down. First half, the government spending is flat. CapEx spending is down 17%. So let's hope that second half, the government spending picks up, CapEx spending picks up. There's been a good monsoon, so consumption, which has been the weakest point in this earnings season, also revives a little bit because the Kharif crop should be good. So these are the things as we stand here. As regards your question on sectors, so in this quarter, we have seen very strong performance from PSU banks. In fact, they are the only component of our coverage universe where we have seen 6 out of the 6 PSU banks that we track have beaten our expectations. Apart from PSU banks, healthcare has been good. They've also met expectations. Real estate has been very good.
The total amount of foreign holding as of the 26th of September, which is when the selling actually began, was about $1 trillion. They've sold since then roughly about 12.5 to 13 billion. That's only 1.2, 1.3% of their total holding. It's a very tiny amount in the big scheme of things. So realistically, taking that much money off the table is really not a big deal. Question is, if they were to take that figure of 1.3, 1.4 to 2.5 or 3% of their total holdings, then I think we have a situation where the market could trend down further.
Okay, that's that on the markets right now. But Pawan, what's your own sense on where the buying would first come in? I know you ruled out that it's not going to be PSUs, given that they were the ones which first took the hit of the fall, some of the fancied names from defense and railways in specific. What's likely to recover the fastest, you think, whenever we, get out of the froth and the poison in the system?
I think one sector which I think from a large cap perspective and very specifically large cap, I think should do well from here on is the BFSI sector. I think except for if you look at the results of the top five banks, which is HDFC, ICICI, Axis, Kotak, and SBI, none of these companies have actually shown red signals in terms of NPAs. And what we understand from our channel checks is that of late in last month or so, deposit garnering has been quite decent. So I think one of the key reasons why this sector was marked down was the mismatch between deposit and credit growth, which I think will start correcting gradually in next 1 or 2 quarters. This is one sector which did not participate in the rally at all in last 2 years, except for ICICI Bank, and the valuations are very comfortable. So this is one sector I think wherein clearly, and this is obviously a large sector. FIIs have always been overweight. I mean, have had large positions in this sector. This is one sector I think wherein you should see some green shoots in terms of FII buying going ahead in next couple of months.
Right, it's banks. Naresh, do you get the sense as well that the recovery too is going to be led by BFSI, that's banking and financial services names? You think so?
Yeah, so that is a sector which has not done well post-COVID. And even in the short term, even in the last 6 months or the last 3-4 years, that's the sector which has not done well and looks interesting. The large cap banking space, many of the names are at the same prices where they were in 2020 to 2022. So going forward, that could be the place which could take leadership and generally tends to see a lot more pressure when FIs are sellers. And once the selling bout gets over, it could be banks and financials purely for the reason they've gone nowhere for a long time. And they are the places where one could see more momentum as we keep going higher.
Okay, banks on the way down, banks on the way up. That seems to be the trend which is building up. But just looking at the screen today and the heat map, look at a GNFC, for instance. That's down a good 7.5%. Metropolis posts its numbers. That's seen a slide of about almost 5.6% as well. RBL, Bandhan Bank, both those stocks have knocked off about 4.5% apiece. Cummins as well has seen a decline of about 4.5% coming in. There's Hindustan Aeronautics down 4.25%. And then, of course, there are the big boys, Hero MotoCorp, which is down 4%. The biggest drag on the index today, Tata Power, which has lost about almost 4%. Hindalco, which is down about 4%. There's IDFC First as well, which has seen a crack of about almost 4% coming in. Motherson Sumi as well, down a good 3.6%. And the realty names led by Oberoi Realty, which are also seeing a significant cool off. 3.5% is the kind of cut that you're seeing on Oberoi Realty alone. But yeah, metals also seems to be quite a bit drag. Pawan, the indicators that we're seeing from China, wherein, they're trying to pump up the economy, trying for all stimulus measures, but that doesn't seem to be quite playing out within the metals market, which again are seeing a big cool off at play. Do you sense that this is perhaps leading to or hinting towards some sort of, global demand slowdown, the kind of crack in metals?
No, I think very clearly the demand for metals is obviously in China is driven by two things. One is the domestic spend on infra and obviously the global demand. And both the things I don't think are recovering very soon. And in that background, I don't think metal prices will go up in a hurry. I think as far as China is concerned, the local economy have got some very serious trouble. I don't think with a few stimulus packages here and there, the economy can clearly see a U-shaped recovery. In that sense, we are not so very gung-ho about commodity sectors and sectors which are quite volatile in terms of global news flows.
Okay, Pawan, Naresh, we leave it at that. Good having you guys on the show as always.
If you like this video, then like, share and subscribe to ET Now.